I can't promise my presentation will be quite as informative as the last one, because that was amazing. But if I do fail to give any information about the Brunner Investment Trust, we do have all the information you could ever need outside with my colleagues, Stephanie Hocking, and so it's all there. So I came last year to talk about markets and to talk about what I thought was going to be going on in the world. So I thought I'd look and see what I said last year, in case any of you were there last year. And I was talking about markets being relatively strong, but the main point that I was making was that it was going to be a better market for stock picking, which is what we do. And the reasoning was that correlations were coming down, so that there was going to be more dispersion between how stocks behaved. And that is exactly what's happened over the last year. So it has been a very good year for stock picking. And that was actually really quite good news, because active managers have had a pretty bad press recently, still have. And so there was some requirement for the active management profession to really show what it could do. Thankfully, it did overall. And in global equities, which is what I do, it was a particularly good year. So that, I think, good, came right. And as far as our own performance, it was strong last year, that in Brunner and in our other global portfolios, Allianz Global Investors. So today, what I'm going to be talking to you about is how in the market at the moment we can find growth and income. Brunner is a growth and income trust, but in particular, how you can find it in a world which is really changing and becoming more digital. And that's something that we've been doing quite a lot of thinking about in the investments that we make. And I think at the moment, we are a very interesting and also potentially confusing, but an area where it does offer plenty of opportunity for stock picking and for differentiation between different companies. So that's what I'm going to be talking about over the next few minutes. So the maturity of this trend is something I'll speak about, and then what it means for us as investors. So how does it change the way that we are analysing the companies that we're investing in? And there are major changes in that. The impact on profitability, impact on barriers to entry, the way that you can measure and value different sort of assets is all changing. And then I will look at some how you find growth, so some of the winners in this environment. And then income, potentially, some of those which are perceived as losers in this environment, but may not be. So firstly, you may not be able to see this, but what this is the result of some work which was done by McKinsey and then Harvard. And they were trying to establish how digital the world was. And they were looking by different sectors. And so they looked through from right at the top, where we've got the very digital sectors, so computing, media, services, and then all the way down through different industries, down to those which were least digital. And those tended to be the more public service areas, but even construction, hospitality. And then they looked to see where the actually assets themselves were digital, what the usage was of computing in those areas, and then how digitally enabled the people were who were working in those. And you've got quite a big dispersion between all the industries, but in every case, they were becoming more digital. And they made some slight differences between areas which were very sort of knowledge intensive, already very digital, some capital intensive, which had a lot of potential to become more digital, so industries, capital, oil and gas, and then areas which were more sort of service-led, and that they had quite a lot of a long tail of retailers, for instance, that were probably all going to go online and were in the process of doing so, some labor-intensive industries, and then at the bottom, these more sort of public sector, And also at the bottom, right at the bottom, farming. But even there, we know that much of agriculture is now going online. So you now have drones, you have satellite imagery, and you have automated machinery. So in every single area, you're seeing this change. And so it's a very sort of fundamental change across all industries that we need to be aware of. And it means that traditionally, as investors, within looking at different indices, we will be looking at sort of technology as one area. But in fact, the world is becoming more digital and more technologically driven. So we need to think about the world in a different way and the way that we invest. So that's really what we've been doing. And conclusions, why is this happening? It's really to do with a couple of things. One is the fact that the technology is becoming a lot cheaper, and that I think we can see in this particular chart, which is showing how the cost of software and hardware has come down, and relative to services, relative to capital goods, you've had a lot of deflation in these assets. So it is cheaper to invest in the technology, both the hardware and software, than it's been. So that's one driver of it. But the other driver is the fact that in some cases, you're actually seeing shortages of labour now, and we've got unemployment quite low, particularly in the US and here. And you have an ageing society, and so you do have a labour force which is a smaller part of the overall population. And that's giving, what you see here, which is a gap. And that is meaning that it makes more sense to have more technology. And in the past, that has driven more spending on technology, and there is no reason why it shouldn't be the same again. So that all is the drivers for why this is happening. It's cheaper and there's more need for it. And plus companies, obviously it helps their profitability over time. What does it mean for us as investors? Well, one of the things which is happening is that you are getting a big blurring of these industries. And you're getting some companies which are setting up this, launching directly digitally into another industry and causing quite a lot of disruption. So disruption is a big theme that's going through a lot of the analysis that we're doing. And it can change complete the structure of an industry. We've seen that in retail. And we've seen it really going through more and more of those industries. Media has been really seeing that as well. And so that's throwing up a lot more uncertainty about growth, about profitability, and about whether these industry structures can actually hold as this sort of tsunami goes through. And it means you need to really look at what the barriers are in much more detail, and to understand them and to see what the impact is going to be, because there are some barriers which can hold, and there are others which just fall. And the ones which have really fallen, anything to do with distribution. As you move digitally, then distribution becomes just nearly free. So we can see that with what's happened with media, with a lot of with music, with film is going the way as well. So the distribution cost comes right the way down. Your barriers have gone. And we're seeing sort of Spotify coming out this week, their IPO. And that is an industry which has gone through and is sort of beginning to think about what it's going to look like post-tsunami, which is up for debate later, maybe. So a lot of change. And for us, when we're looking for this growth, how do we actually find companies in this environment where we can really be more confident that growth, which as an equity investor you really want to see, is going to be delivered. So I've got a couple of stocks here that we are invested in, and we think that they understand the environment that they're working in, and they are benefiting at the top line from what's happening within their own industry. Agilent works in the life sciences industry. It's an area we like, and there are some very strong growth companies like Illumina in there. There's some more solid companies like Thermo Fisher. And Agilent is one which has good exposure to the hardware and also to sequencing. And that, we think, is seeing strong growth because you're getting a more demand for this, for more procedures, more diagnostics as the cost of these has come down. And that's one example of technology cost coming down, leading to greater growth. And they are seeing an acceleration at their top line because this is happening. And at the same time, this is a company where the quality is and the barriers seem to be holding so far. And those barriers are market share, but they're also established market positions and technology. So they do still have better than average technology. And then the last thing we're looking at is valuation. And from our perspective, the valuation of the stock is higher than it was when we bought it, so it's on a 20, but it's still delivering, actually accelerating growth in the 20s. So it looks fair to us. So that, to us, is a decent example of a company which is benefiting from the environment that we're talking about, where you've got falling cost of technology driving growth. And the second one I'm going to show you is one which, when we bought it 5 years ago, was suffering it had a higher yield than average, though it was an income stock. And there was concern about whether it would be disrupted and whether it would be a loser from its environment. And that was the opportunity. And this is a company called Amadeus, and what they do is travel IT for airlines. And they have two other competitors. One is called Sabre, and the other one is Travelport. And they all came out of the airline industry historically. They then went into private equity and came out again. And the debate at the time, which was about 5 years ago when we bought it, was whether they would be disintermediated, whether all of the airlines would be selling everything direct, or whether they would be using a big platform. And the value that we saw that they had was that all of the corporate travel wanted to have the control over the experience, and that the information and the reservations data was so important to all of those involved that it wasn't something that could be easily disintermediated. And that is, so far, has been the right call. And so we've been watching this sort of carefully as it's gone through. And they've also diversified into more giving software services and software as a service to other parts of the travel industry as well. So they've diversified out of that business, and that business has held up better than expected. So you've had there a decent growth, but you've also had a revaluation as well. So now you couldn't describe this as an income stock, but it was when we bought it, and it was suffering from that sort of concern, what I would call moat anxiety. So those are sort of two examples of how you can find some growth, and then you can find some income at the time. And I think there are other examples there, but you do need to be very careful, do your good analysis. And we are very fortunate in having our analysts sort of around the world. We have a lot of analysts in San Francisco who are running pure tech funds, and we are very clued into. I mean, I was talking to them earlier on today about some of the stocks that we're looking at, and we are very connected as an organisation. We have a system called Chatter, which joins us all up all the time. And that's where our analysis goes. Whenever there is any touch point with one of these companies around the world, it's all on there. So we're not the largest in the world, but we are possibly among the most connected. And I think that's very important when you are looking at the world which is changing in the way that I've described. So those are a couple of the stocks. And so as far as the maturity of the trend is, the conclusion of the research was that we are still at a very early stage. So it's all changing, but we're still only about a fifth of the way through this change. And that's because, as you remember on that chart, an awful lot is still sort of to go. So I think our best expectation is that it's going to be a lot of change going forward for the foreseeable future. And so that's the environment that we've got to be thinking about and investing in. And what does that mean? Well, it means that we've got to look carefully at profitability, even more carefully than usual, at barriers to entry. And we've got to think how these assets should be measured. Traditionally, looking at a balance sheet, you'd see land buildings, you'd see bits of equipment, and sort of heavy things that could be easily measured. Now, you have some intangible assets on there, and then you've got some assets which in the business which aren't on there at all. And those could be software engineers, they could be bits of software which have been developed, they could be patents, and they're just not there on the balance sheet. You can't actually see them. And so that's another challenge, so understanding exactly what's in the company. And then understanding how those people within the company and the culture of the company works to maintain the value that you're investing in. And that is obviously a different skill as well. So how is that human capital, which is important in these businesses, how is it being looked after, developed, and then how can you measure it from the outside? So these are all things that we are looking at developing. And I think we're probably, the accounting profession is slightly behind as far as these things are concerned. And that, I think, those sort of understandings means that you can see some winners, and you can also possibly make some judgments about whether things which are being valued as losers aren't actually. So there may be 9 out of 10 actually are losers, but the last one has just been thrown out with the bathwater. So that's the environment, I think, that we're in. That's how we're looking at it, and it's all sort of an interesting time to be investing, but I think it's a good time to be an active investor because there are these big dispersions, there's a lot of uncertainty out there, and that's a good environment if you are picking the good from the bad. So having said that's the environment we're in, this is the Brunner Investment Trust, which is a growth income concentrated global trust. The objective of it is to grow the dividend in real terms and to outperform its benchmark. So it's got to deliver capital growth better than the index, and it's got to grow the dividend in real terms. And it's been doing that. But in the last couple of years, it's been doing it even better. And that's because we've done quite a lot to it. I took it over 2 years ago, having run the overseas part since 2005. And since then, we have made it more global. We have changed the benchmark to be more global. And we have improved the performance. And really, it's really run as one integrated portfolio. And the most dramatic thing that we've been doing is to refinance some very expensive debt that was taken out in the 1980s by the board at that time, which has been a bit of a drag on the trust. There were 2 very expensive debentures. One has just matured in January, and the second we are looking to see if we can refinance at this moment in time. And so that has been a big drag on the trust from all of the time that I've been involved with it. So being able to deal with that now is a very positive for the trust. And it's something which is only really just being understood by the market. Historically, it's been a reason why the trust has been on a discount, and it's still on a discount. And the discount is closing as more understanding about this restructuring of the debt is being understood. But there's still potential upside from what we're doing here. And the exciting thing that once we've done this with the debt, it means it gives us more ability to pay out more dividends, and it gives us much more flexibility in the sort of companies that we can buy. And so from our perspective, it means that the objective of outperforming the index and growing the dividend in real terms becomes that much easier to deliver. And we've been delivering it anyway. So all good news. And the track record of dividends, I can't claim credit for all of this, but this is 46 years of dividend growth. And continuing this dividend growth, as I say, has just been made that much easier by what we've been doing with the balance sheet. And it's very much a focus of the board. It is part of the objective of the board to keep that dividend going and also to make sure that we're outperforming the benchmark. So on that, I've no idea how long I've taken, actually, but probably less than everybody else, because I normally do. So the conclusion, this is what Brunner is all about. As I say, we have all the information you could possibly need outside, or our website as well. So it is a global growth and income trust, and it is one of highest yielding, and it's a dividend hero with that 46-year history. So thank you very much for listening. I will be on the panel afterwards and happy to talk about markets, Brunner, or anything else. Thank you.